Rajesh Kumar joins us now to understand the impact of retail delinquencies because of the second wave. It's it'll be it'll be naive to assume that things on the retail front will not get challenged because of the sheer magnitude of the second wave. Rajesh, good morning. Thank you for joining us. These are initial days, but the impact, I think, is now visible. You can feel the pain, you can smell the pain, and when you make calls to your friends and associates, some of them really are suffering with COVID. What is your understanding on how the second wave could impact the retail delinquencies?
Absolutely. Good morning. Thank you for having me on the show. I think I would like to take this question from a specific perspective to say that when we talk about the retail lending market, you have the denominator, which is the live loan book, and then you have the numerator, which are the accounts that go into delinquency, right? So let's look at both, because the relative pace of growth between the numerator and the denominator here are what really lead to changing trends in NPA percentages, etc., that we often talk about. So first, let's talk about the actual book size of the market. Between the previous year before COVID and last year, the actual growth in the credit active customers as per CIBIL's database grew by about 7%. Whereas in the previous years, it grew by 17-20%, right? But the balance has still managed to grow by about 5-6% versus the previous year. And the good news, therefore, is that there's a little bit of a growth in the denominator. Moving on quickly to enquiries. Last year, if I were to index the pre-COVID numbers to 100, then as soon as last year's lockdown, just to create some relativity here, last year immediately after the lockdown, the enquiries fell straight from that unit of 100 or index of 100 to 10. There was a good 90% drop. Then June, July onwards, things started picking up. ECLGS came in. The enquiries actually grew back to about 40-50% there. And then the October, November, December festival season, we grew back to almost 80%. But most importantly is that in January, February, March, by the end of March, we were actually almost at 100% back to the pre-COVID levels. Then the second surge happened. Now let's look at the impact of the second surge. In April, that 100 had come down to 76 once again. And now as we speak, in the last 3 weeks, the enquiries have actually come down to almost 50, which means half of the pre-COVID volumes in the last 2-3 weeks. That's what's happening on the business side or the denominator. Numerator obviously is another large discussion in itself, which is actual delinquency. Here, I think the good news is that, to be very honest, I mean, as a career risk manager, I can tell you between last year versus now where we are, I would say I'm quite happy with the way the industry and the regulators have done a great job in controlling, in ensuring the stability of the books. So what I mean by that is, you really have these positive influencers and the negative influencers on these ratios. So lockdown, etc., it's very obvious that there are these negative influences on these ratios. But on the positive side, we had moratorium 1, moratorium 2, we have these restructuring schemes, ECLGS was there. All of these are the positive influencers. They control delinquencies, they allow you to time delinquencies, etc. And that has overall led to a growth of about 100 basis points in the NPAs just before the second surge. Slightly early days to study the actual impact now, but if I were to take 2-3 data points and get an idea, I would look at the gross NPAs reported by most of the large lenders and versus the pro forma NPAs of these lenders. We saw a difference of about 100, there was a range, obviously, it's a very large industry. The range was right from 20 basis points up to 500 basis points. But I placed the mode at about 150 to 200 basis points. And it kind of corroborates with my earlier point that CIBIL data shows a 100 basis points increase. And thirdly, if I were to look at the slippages on CIBIL scores, what we call the transition matrix or the CIBIL MSME rank, there is about a 5%. There's always slippage and upgrades, but the incremental slippage as of now, we're looking at about 5% is the incremental slippage. So this is the broad outlook. I hope I've given a picture of what's happening on both sides.
I just don't want to get this one wrong. Are you saying that on the retail delinquency, you expect a 5% uptick because of the second wave?
The credit score, you have various bands of scores, right? So a lot of people improve their scores. Some people get degraded on their scores. So the downgrade of the scores is an indication of future delinquency, not in its absolute, obviously. These are just metrics. So typically a 5% slippage or the downgrades may lead to about 100 basis points or a 150 basis points increase. That is a traditional kind of flow that we've observed. But obviously these are unprecedented times, and we are hoping that there will be a similar trend that follows from these.
Thank you. I just wanted clarification, so I hope you'll appreciate my follow-up question. It was very simple though. My next question is that the data which you are referring to, is it based on April's information? Because we are in May, and May is when the real problem in a sense has only multiplied. So the reference here is what data point or what time period?
So across. So if I were to talk right now about the actual enquiries, which is a good indicator of actual credit demand, we actually see the demand shock that we've been talking about last few days, right? So I'll talk about the May data as well. So go back for a minute. We said 100 pre-COVID. We were almost 100 in March. It fell to 76 in April. Now we are at 50 or almost 48.50. And as we talk the last 2-3 days, the drop has been even more significant in the southern states as expected. And delinquencies, yeah, we'll have to, delinquencies, most of my observations are for the month of, or the quarter ending or the year ending March. We will have to wait a few more, a couple of weeks or so to get a better idea of April and then May.
Mr. Kumar, morning. Given that the Reserve Bank has already given out some sort of relief measures for MFIs and SFBs, particularly at the bottom of the pyramid, do you think that there is a need at this time for more relief measures, either from the Reserve Bank or the government, in order to revive credit?
Again, just my opinion, reading what we all read in the papers, I can see there are active discussions between the bankers, IBA, and the regulators. There are already quite a few measures. We've just completed Morat 1, Morat 2. There is the restructuring that's on again. I'm sure right decisions will be taken in that ground. But in the same context, I would like to add here that it is important to have a positive view to these measures, be it moratorium or restructuring. The way I see it, portfolio health is somewhat like personal health as well. Our health, when you have a wound or an injury, you don't let it take all the damage immediately. We take our paracetamol to reduce the temperature or cover the bandage and let it heal. So these are good measures, and that's exactly what has led to the stability even last year in spite of such a long lockdown. We're just talking about 100-150 basis points increase at an industry level. That's because all these measures really worked well. And last but not the least, please remember that whatever impact we talk about today, it's not like all of that is going to flow tomorrow morning or this quarter ending, right? There are various ratios that are getting offset. So for example, if there has to be a higher provisioning for this 100 basis points or so we are talking about, obviously I'm talking about an industry level, all of these numbers will differ for individual players. So if there has to be a higher provisioning, again, remember that provisions are just another cost in the P&L, which means you offset these ratios with your lower cost of funds thanks to the measures of the regulators today, then you offset these thanks to higher digital business, lesser costs, etc. These things can be managed well, and I think the industry is doing a good job on this.
Okay. Mr. Kumar, if we kind of dissect this now into regions, segments, where perhaps you're seeing efficiency vis-a-vis where you are seeing danger of delinquencies or NPAs, if you could break it up for us a little bit segment-wise and help us understand better, if there are some key trends that are being observed in specific regions or segments?
Of course. So, traditionally, South markets have been very credit active. Tamil Nadu, Karnataka, Chennai, Bangalore, Hyderabad, they're good markets thanks to the IT concentration, etc. from a retail lending perspective. So as we speak now, the last few weeks in South, we see a huge drop in the credit inquiries. So when I look at the civil inquiries, if I see other states having dropped by 40 to 50%, the southern states have gone to 60%, right? Then likewise, I think 2-3 weeks back, Rajasthan and MP had a higher surge of infections, etc. So Rajasthan MP about 2-3 weeks back had taken a bigger hit. Maharashtra, Gujarat, we know. So the problem really with this second surge is that these are all very credit active markets to start with. Then I'll move quickly to product level detail. At a product level, quite expectedly, by March last year, the relatively safer or secured products like auto loans, your home loans, they had all come back to the to 90 or 100% of what they used to be. Even credit cards had come back. Consumer durables typically is a business that takes a bit of a hit when there's a lockdown because dealerships are closed. But again, they had come back to near 100 last year, by March this year. But now when I see these numbers, the biggest hit once again, and including last year, was actually unsecured loans. Unsecured loans never really crossed 50-55% of their pre-COVID through last year. And now once again, I'm afraid this second wave is going to push down the supply side from the lenders on unsecured, because obviously people want to be a little more conservative on unsecured loans. If I were to also take a minute on the actual increase in delinquencies at a product level, as kind of expected, for the very safe products like auto loans and home loans, the increase in the NPAs are less than 50 basis points, really. And then if you see some of the products that cater to the middle class, let's say two-wheelers, etc., which is larger in numbers and more granular, we are talking about a 200 to 250 basis points kind of an increase. Unsecured, again, the increase is more like it ranges from 50 to 500 basis points, but yeah, it can go up to 500 basis points depending on the player's strategy on how they applied Morat 1, Morat 2, and restructuring. And the last piece here is also the portfolio mix. And when I look at the distribution of CIBIL scores for different players, obviously those who have a higher concentration of, let's say, the low score or high risk customers, the deterioration is slightly higher than the other way around.
Okay. Now, majority of the BFSI players have reported high retail disbursements, but going forward, what's your outlook on consumer demand in terms of demand for consumer credit, and whether or not that's going to be hit, what impact that'll have on disbursements?
So I look at it two ways. When I talk to all the senior banker friends, everybody today realizes that if they don't step up disbursements and start growing their books once again, sooner than later, the interest income in the P&L is not going to be enough to pay for some of these increase in provisions that we spoke about earlier. A. And B, I think a lot of bankers realize from empirical evidence that actually post-crisis, we end up buying the best quality books. That's because A, we are a little more careful when we purchase credit as lenders, and as much applies to the borrowers as well. Borrowers are much more cautious and they're more grounded now when they increase their leverage at such times. These are not the times when people make very flamboyant decisions, right? So in effect, you actually purchase good credit at such times, A. B, risk appetite kind of changes at such times for different players. It's also a good opportunity for players to create some strategies around share shift. Can you take some good customers off your competition if they are conservative right now? So a lot of such interesting strategies out to play there, and definitely the supply side, I don't see much of a concern. Bankers are waiting to go back to the teens in terms of growth rates. And from a overall perspective, the way I see it, yeah, this 6 to 8 weeks of the second surge will have some impact, as we saw in the inquiries, etc. But we just have to be optimistic and say the remaining months of the year, the recovery curve is as sharp as the peak happened on the surge.
We'll leave it there. Thanks so much for joining us this morning, Mr. Kumar, and taking us through the latest trends there.